there's this line of thought in the real estate investing world, which is called OPM. And I think that is a disgrace. And I'm very vocal about it. And I don't give a damn about what other people think about it. And whoever built that is mad and it's not ethical and it's not okay. So what I feel is if you want to do this right and if you want to really grow in this space, first of all, you need to have skin on the game. By skin on the game, I mean never less than 10-15% of the total investment requirement. In order for you to have credibility and be able to fundraise effectively, I highly suggest you do not start this journey if you don't have the capacity to hold your seat.
Welcome to Let's Talk Real Estate Investing. In this podcast, I bring you insights, experiences, and lessons from real estate investing professionals at all stages of their journey, along with industry experts who provide essential services to you to help you to succeed. If you enjoy this episode, please hit that like button and subscribe to my channel. It helps me to continue to share valuable content with you. My name is Debbie Balfour, and I'm a real estate investing professional and a real estate investing success coach.
I'd like to welcome to Let's Talk Real Estate Investing my special guest today, Alejandra Moreno. For over 25 years, Ali has been unlocking the potential in real estate, business, and people. She has had the privilege of working in land development, new construction, renovations, and short-term rentals, along with co-funding multiple successful companies along the way as she experienced the pain of failing in others. But here's what she learned. The greatest value isn't always visible at the first glance, and there's truth in cycles, gains, and losses. Beyond real estate, Ali is an international speaker and a business coach who believes business can be both wildly profitable and deeply personal. She's currently writing The Mystic Entrepreneur, a book about building wealth with intention, strategy, and a little cosmic magic. Today, Ali and I will be discussing the do's and don'ts of raising capital, and the don'ts are going to be even juicier than the do's, so you want to stay tuned. Before we get into our topic today, I'd like Ali to tell us a bit about her journey in real estate. Over to you, Ali. Thank you so much for being here.
Debbie, it is always a pleasure to be in your company, in your energy. I'm very grateful for the opportunity to always be in your space. And more importantly, as we were discussing before starting this moment together, allowing to add value through our experiences. And what I noticed in these days is that people just show the nice and the beauty and the great. And there is a breaking or a disconnect between the reality and yes, wealth is created through real estate. Absolutely. Have I built millions doing real estate? Absolutely. Have I lost millions doing real estate? Absolutely. So my intention today here, because of your line of support to your community, which is the best way to find your people to grow together, which equals to finding funding, fundraising, creating a community where you can allow your dreams to come true. And so that's why I'm so honored to be here, because I think we can both add a lot of value to it. And where did I start my journey? As you said, I started 25 years. My very first project was a house hack. And when I house hacked my house, I actually met my husband. He was, you didn't know that one?
No, I didn't know that one.
So yeah, so I didn't even actually own the piece of real estate. I rented it. I had an extra couple rooms. I was 19. And I said, oh my gosh, I can actually avoid paying rent if I can house hack this beautiful thing, renovate it, make it look beautiful, increase rent. And so we did. So I found my 2 renters, I renovated it. And then when I finally renovated this beautiful thing, the owner came and said, oh my, you improved so much in this property. I'm actually going to sell it. And he made a killer sale. But it took me about 6 months to put this thing to where I wanted it to be. And I was very young, very inexperienced, and I felt heartbroken. And the beauty of it is that the person that bought this apartment wanted me to sell her all of what I owned. Like, she wanted the apartment only if The furniture, the design, the plants, everything was there. And I was like, okay, this is so crazy. So I put this crazy number in it and I got married after 2 months of that. And he said to me, let's move to Canada. And I said, okay. So as I was heartbroken, the money that she paid me for all my belongings was a big portion of the money that we had to move here. So that was my first real estate experience. And I'm going to move forward because I've done a lot. So then I did a heritage building. I created my first business in downtown Vancouver. I raised my first $500,000 in my mid-20s. I started acquiring property that I converted, I flipped. Then we did Airbnbs. Then we bought land and I found my partners, and then we bought more land, and then we started doing subdivisions, flipping paper. Then we started building from scratch. We started growing even more. Then we learned more how to fundraise and increase our portfolios. We ended up creating a finished product, a company that would hold $320 million worth of real estate. So from house hacking to acquiring properties to build high rises and support the student rental market, it was the dream. It was really the dream. So there's a huge learning curve in the 20 years of growth. And so what I did in the beginning is I used flipping as one way to capitalize my family. And then I invested in land. So I always had those two lines in my realm. And of course, the business that I created, my husband, he is in academia, so he was never in this more of the, growth, fast paced. He was more of the grounded, nerdy type of human. So that's how we created our life. And by the time I reached 40, I really knew the strength of real estate because the passive amount of income that we received was higher than our expenses. So then I realized, wow, this is something.
Hmm.
And then I wanted so many other people to do the same. So I was very passionate about my real estate because it really changed the trajectory of my life. It really did. And so we started acquiring, and because we learned and the market was great, my one of my partners, she used to say, I think even a monkey could do money in this time of the year. Like the amount of growth in the valuation of the properties year by year was incredible. And so we kept growing until we managed to have about 300 investors in our pool. So we had created a multiple silos within our corporate structure. And that's what we had until there were many variables that you know very well. For the past 3 years, or four, I would probably say 4 years, things really changed. And so we had variables around interest rates rising post-COVID, construction costs rising, a federal and city government changing policies right from left and center, which had a massive disconnect between what Trudeau at that point in time wanted as increased density because of the lack of housing in Canada versus the capacity of the cities to actually execute those changes of policy. So what basically created was this elongated time periods to get any density approved. So if you had one property that you put in your Excel spreadsheet, let's say 1 year of processing for increase of density on an OCP or approved or pre-zoned or a property that you know that you most likely will get that additional density. What ended up happening is that you went from like 6 months, 1 year, depending on the province that you were in. Then it would go to 1 year, 1 year and a half, 2 years, 2.5, 3 years, 4 years, 4 years and a half. So what that
Oh, it's sitting there.
and the property sitting there. So we thought we were very smart. I think we are actually. We, in our very smart brains, said, okay, we're going to acquire property that has a particular set of benefits to it to minimize risk. So what we did is we acquired properties that would have larger homes or triplexes or fourplexes, or we have one with 44 units, having a little bit of multifamily. In what I did because of my design background and my flipping background is I'm going to flip these babies, minimum cost, put Airbnbs, and that's going to really help us maintain these properties while we wait. It worked until it didn't because policy again changed the regulations around it. So they basically killed the Airbnb business in BC. So half of our portfolio that was waiting, delayed, and with an additional layer of interest rates, then we were facing the issue that we not only lost our income, our interest rates doubled, like our mortgage payments doubled, and they cut our capacity to Airbnb, meaning rent the properties at a higher rate. So then we had to go and be forced to go down to a long-term rental. And the gap between the interest rate versus the lack of income started to snowball. And then the uncertainty of the cities are not responsive.
Right.
And so we had a massive amount of product being built. And then because of this whole issues, then the DCCs, meaning all the fees that the cities were requiring, basically doubled. So we had a budget of $250,000 for a subdivision on the island here in BC. And when the check came to be, the city requested $500,000. Just a blink of an eye. And then there were because there's a blue and a red party in every single city, then if you purchased one property with an timeline, let's say 1 year, you knew that you were within the same ruling or mindset at the government level.
Right. Of the current government.
The current government. And what happened is because cities took so long, then we switched governments, and then anti-development governments came to play, and they stopped completely in some of our cities that we were in. And that was a problem. So we actually ended up suing one of the cities because they were against the federal mandate, because they just didn't want more development. We were being hit with so many problems. And then we said, okay, you know what? It's okay. It's fine. We can still do this. And we focused on the properties that were stronger in the stronger markets, which meant student rentals. And we had our biggest set of properties closer to universities. And then beautiful government decided to close the doors for student rental and shut down all the international student visas. And then the cities got all freaked out and they pulled out the density that we were going to be granted.
Right.
Meaning none of our projects penciled out anymore.
How could you have predicted all of these? It doesn't, I'm sitting here thinking of a risk mitigation plan that you could create, but you would never think that all these different variables, like you had a backup plan and another backup plan, and even the backup plans needed risk mitigation.
You're so right, because you plan to have variables at a particular percentage. And I'm going to tell you what I learned from this, because the first thing is, yes, we couldn't have foreseen so many changes, so many blocks, so many problems. You're right there. Now, there's always cycles, and every cycle will teach you something very important. I had the pleasure of talking to somebody, and I'm actually thinking about it because I don't know if it was a pleasure, because what he had to offer was very poor. But I was grateful for the opportunity to talk to a fund manager for distressed assets when things got very complicated. And what he said is, I'm pretty sure you had 3 to 4 variables in your Excel spreadsheet that could go wrong. And now you have 8. And that was the reality. And he said, the reason why I exist is because most people will create a very good contingency cushion, but I know that every 20 to 35 years, those contingencies will double.
Right.
And so, of course, I did not take the offer that he suggested because it was going to be detrimental to my investors. And I took the risk of saying no because it didn't align to my values, what he had to offer. But he did say something very important to me that I would like to share. And that was, I can guarantee you that if you had 2 billionaires in your pool, you would not have a problem. You would just reallocate and restructure your capital stack. And I'm going to explain this a little bit further. Well, we were trying to salvage our portfolio, which by the beginning of 2024, I decided to stop taking external funding, and I started putting my own funding. I funded this thing for a year and a half with my main partner. So we didn't take any funds, and we started selling everything. We saw the Porsche growing, the houses, the rentals, like we saw everything go. And so when we made this plan to sell a few properties fund within ourselves because we had enough land, enough improvement, and enough densities approvals, even though it took forever. But we did get a few. We did manage to build a few properties that were ready to sell, even with the market condition dropping. We could still make the numbers work if we unified all the properties, build them, and wait 7 years for exit until the market correction would pass. And so that's what we did. And we were very, very, very close to do it and making it work. So we sold the 2 properties and we said, okay, I think we can actually make this work. We knew by then that because so many investors were losing so much money in other development companies, we had people with 15 deals down, 20 deals down, 30 deals down, like complete wipeouts for passive investors. And we said, okay, we might need an extra set of money, a little bit more money to pull this through. And there was probably a 15% out of my pool that was able to allocate more capital to make this work.
Yes.
And so what this guy told me when he was trying to acquire my portfolio he said, if you had really deep pockets behind you, you would not be in this problem, because the way you never go to where you are right now is if you and your investors have 100% of the money of what it takes to get this baby built in a savings bank account. That's the only way you can really mitigate risk in tough cycles.
Right.
And I was shocked by it because I never saw it that way. Because I never lost a dollar making my business in real estate for 20 something years. I never lost $1. Okay. So I never knew what it was to have a deal not work out for me. And that's the reality. Like, I think I got cocky that way.
Right.
And what he said to me is like, I remember 35 years ago what happened. So I was there. So now what I'm passing on to you is that wisdom. You have to be very careful with who you partner when things go wrong. And that doesn't apply only to your capital partner side, but it also on your operator side. Okay. I have multiple partnerships and not all of them are equal. That's all I'm going to say. And so when you are in a position as an operator, because I think this podcast is more targeted towards operators,
Yeah.
I would very much focus on not the money, because money is easy. Funding money is the easy part. Finding the right money partners is different. Okay. So you have to really understand that in real estate, things can change very rapidly. And you want to be able to have 2 phone calls and make sure that your project will be funded at any point in time in its entirety. Now, what happened to us at the very end on this big portfolio that ended up going bankrupt, we were 2 weeks away from putting a high leverage financing process with CMHC and get the first building built and hold the other ones while we kind of rolled the capital from one project to the other one. And when we were 2 weeks away from that, then CMHC changed the ruling again, and they went from a high leveraged loan to value for construction, which was at that point about 95%. We only needed 87% to hit the numbers because we inter alia our whole capital stack in our equity. And so when we managed to get to the 87%, which was amazing, CMHC changed the policy and they dropped it down to 75 again. So I needed an extra $15 million. And they changed it in a day.
Wow.
Okay. So when everything was ready, refis, CMHC, okay, let's sign. And we created a debenture structure for all our investors. So we unified the capital stack, restructured the capital stack, sold the projects, refinanced 2, sold 2. At that point, we had 3 lawsuits ongoing for mezzanine debt that was impatient. So we mediated with them. Okay, well, don't worry, we're going to pay you. Like, my 300 investors are with me. It's going to happen. When CMHC changed, it was the last straw. After that, the refinances pulled out. We got more CPLs on our properties, blocked the titles. And at that point, it was beyond return.
Right.
So it's a very scary story. For people who are in this space, I don't wish that to anybody.
So what I'm hearing too is that for someone that's just a small investor that's done a few flips, that's maybe built a few properties, jumping from something like that to trying to do like a $300 million project, is a big gap. And it's not something that you should go into lightly. You need to have lots of experience behind you that can understand all these variables that could go wrong, and also have the funding behind it. Because, like you said, if you couldn't go to your investors because they didn't have enough money to say, oh, yeah, I'll now give you the extra millions of dollars now that you need to compensate for in order for this project to go forward because of the change in CMHC financing.
Exactly. The funny thing is that after speaking to so many people, of course, I was in the medium-sized developer problematic situation, whereas I have a lot of smaller investor friends that had the exact same issue, just in a smaller version of me.
Which is what we want to get into right now. We want to talk about, because of your experience, what are things that people should do? And actually, maybe these do's are because you learned the hard way. And then we're going to talk about, definitely do not do these things. So, so let's go with the do's.
The first thing, and this is actually that's something that I did in another webinar, and it's think of it as a triangle. Okay, so you have your product, your capital, and your operations. So there's three things, and I always draw this and I actually build a webinar around this simple triangle because it's very important. So the first one is the product. What asset are you very comfortable in managing? If I'm talking to an operator, I'm assuming that this person has done at least 3 exits that would give them the sense of, yes, I can do this.
Right.
Okay. And they have made enough mistakes to know what to do and what not to do. Then you're talking about the operator systems side is, okay, how can I execute this beautifully and effectively? So if you have your product that you're very comfortable with and you have your systems around it, then really you need the third leg, which is very easy because capital follows management. And I'm going to say this again. Capital will follow management at all times. So when you have an amazing couple exits. And this is what happened to me. And I'm talking this is like, and all of this is because I've lived through it. The
Yeah.
bad, the great, and the ugly. So when you do a few projects effectively, you are like honey to bees.
Yes.
You don't
So
need to
you're
talk much.
because you've got your credibility, you've built your credibility, you have the experience.
Nowadays, they do need you, Debbie. And I told you this when we started this conversation before we jumped in. I'm going to say this. You at this point in time might be great, but if you don't have the right messaging, you won't be able to get to the people in the right rooms. Okay. So, and one of the reasons why I'm here is because I love what you're doing, because you're helping people get to those rooms in a beautifully clear, transparent, and organized, systematically, beautifully done way. Okay. So when you are looking at, yes, I've had a couple exits and I'm very comfortable around my systems and I'm going to focus on this one product that I know. Then you have the third wheel, which is building your network. And building your network is different if you're doing a $300 million portfolio than if you're doing a duplex or a condo flip.
You're definitely in different rooms.
You're definitely in different rooms. So you want to understand which room do you need. It's better to have any room than no room. Okay. So there's a lot of people that are in their head and they're like, oh, I need to find like, I need to find like my next capital partner. And I've never had one and I'm so excited. And I'm like, okay, which rooms are you going to? Oh, no, nothing yet. No. Okay. We have a problem there, right? So a room is better than no room. And the room is going to give you a beautiful mirror of who you are. Okay. And I'm going to say this again. It's not who you think you are, it's the perception of who you are. And again, that's why you come in and you want to really polish the optics around how do you present to yourself, your projects, and your expertise. If you're decided to be an operator, I'm going to say this very, very clearly. If you don't have these 2 areas very well positioned, meaning your product, your experience, and your systems, do not take other people's hard-earned money. Okay. It's just not. So you're going to go there. And I actually did this crazy, I'm actually going to post it because I haven't posted this, but I did this analogy around having a person that wants to be a tennis player. And then he, instead of hanging out with or finding a mentor in the tennis playing like world, they go and hang out with swimmers. It's complicated. Okay. So, and if, let's say that you have even no money or no expertise, but you dream of being an operator. Like if you've never done anything and you want to get in the space of real estate, hang out with people that, are learning, or you can get a mentor. Let's say that you have no money for a mentor. Pass the balls. Like volunteer your time. Walk around people that are doing what you want to become one day.
Offer to help them.
Offer to help somebody and get that experience going on. Go into a very low pay job, volunteer, build something with this person, learn, and then you need to take the risk. So when I first started my business, I saved every single dime that I had for 2 years. And I knew that it was going to take another 10 years to fundraise the amount of money that my business model needed. So I decided to jump and fundraise the remaining amount. And I was in my mid-20s, but I come from a very entrepreneurial family. And I studied business and I studied international. So you need to understand who you are too. And with that, I mean, I knew I didn't go to Harvard, right? So Ivy League was not in my books. I went to a South American university. So my rooms are not going to go with Rockefeller day one. So, but also if you went, for example, and I have a lot of friends in the trades world. I love my trades. I have great friends in the trades world, and they are part of my teams, like core teams that they have supported me and I have supported them for years. So they wanted to get into the space of fundraising, for example. And for them, understanding that the rooms, they belong to the rooms. So, and I'm going to try to explain this better. So let's say that you were in an Ivy League and you have a birthright for a particular set of rooms. And then you went to BCIT for a trades program, right? And then you have the middle room in the real estate investing world. I'm just going to make up like layers just for the sake of it.
Yep.
It's on your mirror to feel that you can walk into the Rockefeller's room and still rock it.
So in your mindset needs to be, I am a Rockefeller person.
Pretty much.
And then you projecting that.
Absolutely. And the projection comes with one experience. So what does this mean? Most people that are fundraising money, I find that they come with this scarcity mindset that I need something.
Yes. And begging people for money instead of
or just want to get something from you. I don't think I've had to do that because one of the people that I admire the most, which is my brother, he's built multi-million-dollar companies and he's incredible in the tech world. And he said to me one day when he was selling or thinking about selling one company, and he said something to me that stuck with me. And he said, nobody wants to buy a company that's for sale. And this is so good.
Nobody wants to be sold.
And nobody wants to buy a company that's for sale. Like if you're selling a company, probably what's wrong with it?
Yes.
Like what's going on? Like why is this selling? It's making so much money. You want to be acquired. Like you want to become the honey to bees.
Right.
And so all of what you do, Debbie, I love because that's what you help people realize that if you have the experience and if you have the asset class that works, that you have multiple done it with excellent returns and results, then you can say, you know what, I feel very comfortable about this. Okay. And so that's what I would probably sit as a young operator and say, I know this. The other thing is, what skin on the game do you have? Okay. This is another thing. And I think one of the reasons why I am where I am, even though my company went bankrupt and it was a project that didn't work and I lost millions of dollars, but I lost millions that were owned by me as well.
Right.
So I see there's this line of thought in the real estate investing world, which is called OPM. And I think that is a disgrace. And I'm very vocal about it. And I don't give a damn about what other people think about it. And whoever built that is mad and it's not ethical and it's not okay. So what I feel is if you want to do this right and if you want to really grow in this space, first of all, you need to have skin on the game. By skin on the game, I mean never less than 10, 15% of the total investment requirement. You can go higher. We definitely went higher. We were up to 25% between Mimi and I. But in order for you to have credibility and be able to fundraise effectively, I highly suggest you do not start this journey if you don't have the capacity to hold your seat. Okay. So if you're expecting to fundraise and use other people's money, you have no idea the responsibility that that means. You have no idea like the amount of tears that these chicks have felt because of my sense of responsibility towards receiving money from families that I deeply care about. Because I found raised every single dollar that came into Honeybee. So I don't wish that feeling to anybody. And that's one of the reasons why I'm here with you, Debbie, today, because it's important. And people never think of, oh my God, what if it doesn't work? What I'm going to do? And I saw many operators and many fundraisers fleeing, leaving, shutting doors, never talking to anybody again, killing themselves, two of them. Because it is an awful situation to be in. So when you're excited and you're like, oh my God, yeah, I'm going to fundraise and it's going to be great. And you want to think on both sides of the coin. And there's always two.
Yes.
And I tell you this because I didn't think of that. Okay. I just kept growing and kept growing. And I never thought that things could turn on me. I never had that in my system.
All right. Yeah.
So I don't wish that to anybody. So
Let me stop you there, Ali, because I want to summarize some of the things before we add more to it. So number one, you said to have your product and know your product, stay in your lane. Don't just try something new when you're trying to fundraise. Have something that you know and that you have systems around it. And then make yourself visible so people know what you're doing and be in the right rooms that you need to be in for your product. But your product is also you. As real estate investors, we are our brands. We are our product first. People are investing in us before they're actually investing in the actual deal. So that was your first one with your triangle. Your second one you said was that you said have skin in the game, have money in the investment, at least 15% of money. So you can say to other investors, I am putting my money into this too. So I am going to be working very hard in order not to lose that money. The other thing I heard you say is that a lot of these families, it was their life savings, and to have them lose that is a lot. So understanding who you're taking money from and understanding if something happens, how would I feel losing someone else's money? So putting yourself there, that pain and that anxiety that you'd be feeling. And I think for most people, that is a worrying thing, that could be lost. So understand what that will mean to you. How are you going to feel? But then is this the last dollar that they put their life savings in this? How are
We're
they
going to get into that.
going to be affected? So those are some of the things I heard from what you were talking about.
100%. So then we get into the yes, you will always be stronger. You will always be stronger when you partner with people, meaning fundraising is wonderful. I don't know any company that has expanded without, well, I actually do know a few, but it's rare. So if you are looking to fast track your capacity to become an operator, then I would probably say, you know what? Yes, fundraising is a beautiful avenue to grow, to acquire more, grow.
In order to scale, that's what companies do. They fund it.
100%. 100%. Now, there's different ways that you can fundraise. So let's say that your operator, your audience, Debbie, they already have the product, they already have the systems, and they come to you and they say, Debbie, I am so ready. I built my first corporate structure. We can be a very simple one and say, okay, we can talk about corporate structures in another, because that's a big, I don't think we're going to get to that one today. But
the do's and don'ts of fundraising.
Yes. Yes. Let's say that they come and they are ready with their first company and they have their holding, that it's ready to go. And they say, okay, I'm going to, for this particular investment, I need 4 investors. for $50,000 each. And I'm putting in 100 and I'm ready. So I have my $100 committed in this corp. I have this property under contract. And because they worked with Debbie, they already have the room and they already have the people that want to work with them, right? And then you go to the next layer. And that is, okay, the room is ready. The people are ready. Now, how do you choose your investor? And I think this is very important. And this is something that I'm actually going to share a story.
Yes, please do.
That I will probably cry. I hope not, but I might cry because it's very close to my heart. But you get to the point, I'll tell the story in a second. I'll get to the story in a second. But so what happened is that you need the money. So you know that you need $200,000 out of $50,000 each. You have the room. And then you say, I need to choose the right investor for me. So if you're desperate for money or you will take anybody's money, and you don't have a procedure around money, then that's where pain comes when things don't go as planned.
Because not all money is the right money.
Not all the money is the right money. And if you don't understand that, you should not be in this business just yet until you really do. Because there's not only ethical issues around it, if you know, right? If you already know. If you don't know, well, you didn't know. But if you already know that there's an ethical issue and then there's a legal issue. I'm going to tell you what happened to one of my very, very dear friends. Okay. So I had a house and she lived in the bottom of this one house for a few years. Adore her wife. I adore her. Adore the kiddo. Like they're just a beautiful family. And so she saw me grow and she came to me one day and she said, I want to invest with you. And at that point I was fundraising for an acquisition of 44 rental units in Waterloo. We were going to build a 25-story tower there. And that project is still ongoing, by the way.
Okay.
And she said, I am so in love with what you do and I've seen you go and this is what I want to do. And I'm so excited. And I got so excited. And she's a friends and family because I adore this woman so much. So I'm like, absolutely. And I was so damn sure of what I did. Like you get to that
make
point.
her money. You were going to.
I am going to send your kid to university because I'm going to do this. And I'm so happy that you're coming in my journey. And I was just so ecstatic about her coming in. And then she ended up investing in 2 other of my projects, smaller amounts. And for this particular project, she put about $400,000 of an investment in this company, in the Waterloo project. And I was so goddamn sure of what I was doing. And at that point, I didn't have my securities commission lawyer set up. I didn't have, because I had been raising under 50 investors in different corporate structures. So I didn't need to get to that point.
Right.
So when I started doing register funds we created a mutual fund trust to be able to receive register funds through our GPLP structures. And so when that was set up, she said, okay, I want to put my investment there. Great. I did not know what I do know now.
Right.
I didn't ask the right questions. And that's why I told you that I'm building this webinar that needs to be out there. So you know what to do and what not to do. Because my biggest pain points came out of ignorance. Okay. And when you scale so fast the way I did, a lot of things were done without crossing the dots. And that's my responsibility. And I did have to forgive. And I'm going to tell you what happened to that episode. So this project, as all my projects, went into a severe, and we faced the risk of losing all of it. And it just so happens that she's in one of the silos that are still ongoing, but she lost the other 2 investments.
Right.
Okay. So she kept one, lost the other 2. And in one of my darkest nights of last year, she came and knocked on my door. And as you know, I disappeared for a full year until I could reset myself.
Right.
But I opened the door and she looked at me and I was devastated. And she sat down and said, what can I do to help you? And I started crying. Like I don't think I've cried like that before. And I couldn't move. And I said, I cannot live with the feeling that I lost your money. And when I was looking at her, I was looking at my 300 investors and my family and my husband and my kids. I wiped my family down to the ground. I'm living on a freaking rental. Okay. I stripped down my whole entire life and others. And so I was on my knees and I was asking for forgiveness. And I was so sad. And she looked at me and I said, "Would you forgive me?" And I told her, "I don't think I can actually allow myself to thrive again. Like, would you allow me to thrive?" And it was this plea of desperation, of sadness, of anguish, of being on my knees. And she touched my head and she said, "I forgive you and I let you to thrive. But most importantly, I don't think it's us that you need permission from. I think you need to give yourself permission." And she said, "I signed the dotted line. I knew that it was an investment. I know that things go right and I know that things sometimes don't." Right. So I'm telling you this experience because if you can't feel my pain in that moment, it will make you think twice before taking money. So what could I have done differently? And this is where it gets better. That's why I'm here. Friends and family or not. Because friends and family, you can take as much money as they want to give you.
It's an exempt, and a lot of people run for that.
I urge you, the closer the investment gets to you when things don't go wrong, don't go the way you want, the closer they are, the higher the reactivity will be. Okay. So what I should have done is do what I do with any other person now, and that is really understand their net worth. You do not take more than 10% of their total net worth, and you make sure that that is actually diversified across 10 non-collateral investments, right? Like, so they have to be not all in real estate. I should have asked those questions when my investors came to me and said to me, "I have 30 deals down." And I asked them, "How many deals do you have outside real estate?" And they said none.
Lots of more real estate.
And it broke my heart. And I'm like, "Oh my God, you are." It's like, but I thought I was diversified because I'm in Waterloo, I'm in Kingston, I'm in Langford, I'm in Edmonton, I'm in this and in that. They were all real estate. So out of 300 investors that I had, because my rooms were so heavily
real estate investing focus. Yep.
Yes. Then all of them had 15, 20, 30, 35, 40 deals, 50 deals, all of them down. Entire net worths put in one area of investing. And it hit me because I was not responsible for them investing in 50 deals, but I felt responsible for whatever, right? So it was this thing that I had in my chest that I couldn't breathe. And I said, okay, as an operator, next time I will ask these questions. And even if they can only invest $5,000 with me, that's what I will do.
Right.
And so, and if that's the type of, and then maybe you are in the wrong room. So you have to really figure out how big the rooms are. And if you're looking for a $50,000 investment, it means that your person needs a net worth minimum of $500,000. He's not heavily invested in real estate, or she. So that is one rule of thumb that I would follow to the end of my life. I don't think I am in the place where I would like to fundraise at all right now, but I can teach you a lot around it. Like what not to do. And I know when I start growing my businesses again, I will go back to being able to partner, but it'll be a while. It'll be a while for me.
Rebuild your confidence.
More than confidence is, I am rebuilding the way I am going to first rebuild because I need to create my 15% part.
Right. Yeah.
Right. So until I find that 15% where I can commit and I am, as my family, doing the same thing, I need to create those 10 non-correlated investments so I can put $50,000 here. Right. So it'll be a while until I get back on my feet and I'm able to do that. So first of all, when you're fundraising, understanding the person that you have in front of you, vet their risk capacity and profile, and preference. And what do I mean by that?
Yep.
Their tolerance. So I'm going to tell you something that happened to me. I lost my best friend of all times in this process. And I still have nightmares and dreams and I wake up dead sad about this. She put she invested in one deal as an equity investor, another one she invested as a short-term loan. And this is a big one in the real estate community because people teach this stuff. And I am so against this right now. It's not even funny. I didn't see it as dangerous until it happened what happened.
Promissory notes?
Not only the promissory notes have a place, okay? Promissory notes have a place, but the investors that leverage main assets to get into a prom note, that's a problem. Okay. So, and this is another huge lesson for me. And I did not ask this question. Are the funds that you're deploying as a short-term money leveraged in any way, form, or capacity? So there was a disconnect between the investors and they've said to me, many of them, it's like, oh my God, I just got very greedy.
Uh-huh.
And it's not only that, other people were like, oh my God, I'm able to actually pay this because I got divorced and this money is allowing me to survive. Like things like that, right? So, but one very important aspect of this is for people that are taking temporary funds, you have to ask the question, is this money leveraged in any form or shape? The disconnect lies on, it's not that you don't do promissory notes. I know a lot of people that do crazy promissory notes and do crazy money, but with the right structure. What happens? You have a really high interest rate, like crazy interest, like 16, 18, 20%.
Uh-huh.
And that's a hell of a lot of money. And that risk is this big. So the issue is that people perceive promissory notes as really high interest rate and very little risk. Okay. So it is the responsibility of the investor. This is not the operator. Okay. Then you have to realize that if you're doing this much of a return, you're doing this much of risk. Meaning, if you're doing 10 uncorrelated investments and you have 2 in real estate, one for equity and one because the leverage on 16, I have investors that did crazy money with me and with many people for years doing promissory notes, like crazy money. I have one investor, she's a very large investor in my pool. She was doing over $200,000 a year in interest. Okay. So, and she did this for years. So it's a great strategy but with the right preference and profile for risk.
Your HELOC.
And that was the problem because people were teaching to leverage HELOCs for short term and take the difference.
Instead of money that they maybe had in their bank accounts. That wasn't, it's not borrowed money then, because when that money's gone, now you're on the hook to repay that money and to pay the interest.
Exactly. Exactly. So what happened is that the perceived risk on promissory notes were almost equalized in these communities as if it was equity, just a higher rate. And nobody saw things going wrong because we've been doing promissory notes for years and years and years, like 10 years. Everybody's getting paid. Nobody missed a payment.
Because money was free, the interest rates were so, I would say money was free because the interest rates were so low. And then the market was just going up so fast.
Exactly.
Yeah.
So then what you want to think and really think about is, all right, I have an appetite for a massive, crazy return, knowing that I can lose this money. Can I take that risk? So do I really know this operator? Do I really know the market? Do I really understand the exit strategy? Do I really know? So this is where the capacity of the investor to really understand and the operator to see if they are both aligned. So one question that I would ask as an operator, how long would it take you to recover this money? Would this money affect the well-being of your family? Would this money be something that in a way would hurt, but it wouldn't kill you? So what happened in my pool of 300 investors, because I did not initially ask these questions until I was regulated, until I knew in my next layer of growth
that you should have been asking these questions.
I should have been asking these questions. Then what happened is that a big portion of my pool was highly leveraged and they did not think about 10 uncorrelated investments. All their money was in different deals, different operators in the same market. in the same line of work. And that's where the real pain came. So all my accredited investors, we're incredibly great friends. They're like, oh my God, I signed the dotted line. I've seen you try so hard. They're normally people have a massive net worth, and they invited me to their wedding and they call me to see how I am, and they're checking up on me, and they come to Vancouver and we go for lunch, and it's just a conversation of that. And there's no real emotional baggage. So the problem that I had is because I did not ask those questions in the beginning and they got caught up in this massive issue.
And not
They
just with you, because
no
you're multiple, the same things were happening with other operators.
across Canada. It
Yes.
was across Canada. So that really created this massive amount of pain. And then so the best friend that I was telling you about, and like she wanted me to put a particular guarantee on my house and say, my God, like you will pay me because like you will protect me. And so when you're taking funds from people that are very close to you, right? That will get very painful. I lost that friendship.
Yeah.
And that was hard. And that was really hard. So I would not wish on anybody to have to go through the sense of loss, not only for your business or your identity or what you have built for 25 years, but also the people that have seen you grow and that were supposed to be there when you were low. So I would almost, unless you do this very thorough, not only that, but also legal, like legally speaking, that's another conversation, but in a way that the ground is protected for both sides. So that's another do not do unless it's very clear.
I'm just going to summarize this bit that we've just said. Like, don't take just any money, anybody throwing money at you just because they're excited and they want this opportunity. Money isn't the same across the board. The do part is do qualify that investor from a perspective of not just, can you give me and are you willing to invest this money? But that money needs to be only 10% of their net worth. And also you need to look at what their other investments are. And it can't be heavily in real estate. Like we saw, many people were invested just everything they had in real estate. Do not take money from people who are actually borrowing money in order to invest this. Because if that disappears, they're on the hook to pay back the money. It wasn't money that they were sitting in savings. They're on the hook to pay back that money plus the interest on it. Where are they going to find that money from? You would stay away from friends and family that have that emotional connection, because not only are you losing the money, it's not just an investor you've just lost that lifetime relationship that's beyond money. It's emotional. And do everything legally, do qualify. And if you do want to take that person, make sure you're evaluating it the same way you would evaluate any other investor.
As much as there is an exemption on friends and family, use the exact same way of qualifying that investor in your pool because it's even more sensitive.
Thank you so much, Ali. I really appreciate your vulnerability. I really appreciate the stories that you've shared with us, because I know that they come from the heart and they come from really hard experience. And like you said, you had never experienced any loss before. So you were confident, you were cocky, but now you've been there. And I applaud you for starting over and for not burying your head in the sand and
Thank you.
trying to make it go away. I applaud you for sharing with everybody your lessons.
My pleasure. And as I told you, I'll put this one resource for everybody to go through it in 2 hours and never have to have an issue with this. So it is my promise to you. It is going to come to your community, and I should have that in the next 30 days for you.
Sure. So when Ali does have it out, I will share it with everyone, but we will also share your contact information with others so they can get in touch with you.
Absolutely. If they want to know what I'm doing next, they should follow me on Instagram. So I'll give you that handle. It's coming, and it's coming strong, and you will love this, Debbie. It's great.
I will be following you, Ali. So thank
Thank
you
you.
so much for your time. For everyone, if you like this podcast, please hit that like button and subscribe. so that you will get notification when I drop other episodes of Let's Talk Real Estate. Thanks everyone for joining us. For Ali and Debbie, we're out.
Thank you. Bye bye.